Thanks to Morgans for inviting me to be here today, and thank you to each of you for taking the time and showing the interest in Pinnacle. So I'm really delighted to be here today for many reasons. One reason is that I'm a proud Queenslander, and I'm so pleased to be able to come back to Brisbane as often as I can and remain connected to the Brisbane business and investment community. In fact, it's amazing how many people think I still live in Brisbane. I'm asked that all the time, where do you live in Brisbane? In fact, I'm a Queenslander living in exile, having moved to Sydney 31 years ago. My background is that I was born and grew up in Rockhampton. I moved to Brisbane just as I turned 17 to attend University of Queensland. I did that on a bonded scholarship from the Queensland government. Then just as I turned 20, I was invited by Leo Hilscher to join Queensland Treasury. Leo was by then already under Treasurer, and he became one of my most important early mentors, and I owe him an enormous debt. Actually said to him a little while ago, I visited him. I said to him, "You stole my youth, Leo." And he said, "You gave it willingly and you haven't done too badly as a result." So he's just as sharp as ever. So I love working in Treasury. It was everything I'd ever hoped for my early career. Great experience, very important work, fast promotion, dealing in projects and investment deals and so on worth hundreds of millions, sometimes billions of dollars. And back in those days, $1 billion was a lot of money. And positively impacting the lives of so many people, which has always been important to me in my career. Stayed there 15 and a half years all up. The last 2.5 years was a joint role. I was a first assistant under Treasurer in Treasury, and I was, sort of chief executive of what they call the Queensland Treasury Corp Investments Board, which John Allpass can talk all about. It was kind of an interim period before we formally set up QIC, but the investment trust was already set up and we were running that very big investment portfolio, which is mainly the Q Super money, etc. But as Brian said, as one of my jobs was figuring out what to do with all that money, and that's how the QIC was ultimately set up. So I thought that I'd stay in Treasury for perhaps the whole of my career. I would have considered that a privilege if it had worked out that way. My ambition was to be under Treasurer, but the QIC board invited me to become full-time CEO, and I loved the QIC role immediately. I started in it. That's how my career in investment management started. QIC was a wonderful experience for me. We set up a very high-powered board in early 1989. Jim Kennedy was chair. Jim was also a mentor of mine. That whole board was. I was a young fellow out of the public sector, and they helped me find my way in private sector matters and so on. We had Alan Coates, who'd been AMP chief executive, really took me under his wing. Charles Good was a senior stockbroker from Melbourne. Brisbane-based Ken McDonald from Faze Ruthning at the time. John Allpass, who's here today, which I'm delighted about, from KPMG, was on that original board. Don Sanders, who'd been Reserve Bank Governor and so on. So it was a really great group of business people that I had the privilege of working with. And in late 93, I was talked into becoming MD of Westpac Investment Management. It was a turnaround situation. This involved me moving to Sydney with my young family, 3 small kids, and fully into the private sector. I still wonder how I got talked into moving. I had no intention of ever leaving QIC. I loved it. I was on a mission to do something really great at QIC. We felt that we were breaking the mould. We set it up because we thought most of the funds management industry wasn't good enough, wasn't according to the standards of Queensland Treasury in those days, and we thought we could do it better. But in the end, for some reason, I ended up, it was put to me as a bit of a challenge, I ended up moving to Westpac. I love living in Brisbane and still ask myself what the hell I'm doing in Sydney every now and then, although our kids have grown up there, we're well entrenched. And Brian outlined the rest of my career, perennial in Pinnacle. Most of my extended family still live in Brisbane. So I'm not going to go through all of this kind of stuff, but it was out of my experience at Westpac, and then I almost went to become CIO of what was then National Mutual, AXA. I kind of had this epiphany that the traditional funds management model was seriously flawed, being owned by banks and life companies and so on. I was always about excellence. Nowhere is excellence more vital and necessary than in investment management. And I just thought we weren't really getting it. I thought we'd done well at Westpac, but you couldn't sustain excellence in that kind of an environment. So I kind of progressively dreamed up this best of both worlds models where it would be investment-led. These organisations, talented investment people tended to be sort of pushed down, not listened to. So boutiques were setting up, and I felt that these boutiques where the most talented investment people were leaving, setting up their own businesses, they created the right environment for investment excellence. But also I had the insight from my experience that you need more than just investment excellence. You need to run a strong business, you need to be great with your clients, you need to be good at distribution and ops, etc. And there are scale benefits in that. So the best of both worlds was a multi-boutique, where each boutique is majority owned and led by talented investment people, but then they're supported by excellence in distribution, investment ops, etc. So it's pretty damn simple when you think about it, and you've got to ask why there aren't a whole lot more multi-boutique fund managers around the world. There are a number and a lot of good ones, but nowhere near as many as there should be. In fact, not long ago, I was in London. I'd spent a lot of time in London in the last year where we'd finally sort of done the deal for our new team, former Royal London Global Equities team. We were sitting around exhausted because Royal London finally had refused to negotiate with us, which was a whole other story. But the guys said to me, there's something that we're perplexed about, Ian. They said, we searched the world and we knew what we were looking for to be set up in the perfect environment. These are one of the best investment teams in the world. And they said, we come up with Pinnacle and not much else. How is that? And I haven't got time this morning to go into it, but it's a lot harder than it looks. You have to get up every day and keep executing on it. But it's extraordinary. There are not more Pinnacles in the world. And this is the basis for which we are able to expand overseas. We're expanding at now a great rate of knots. People get frustrated with me because I say we're going to do all this expansion, then I say we have to be careful and we go more slowly than people would like, but that's what we're doing. People are now starting to see it. Steve, we've been working on it for years, but people are seeing what we're doing overseas. We're expanding our model overseas. We're going to become an export industry for Australia by investing foreigners' funds. It's growing. It's about a bit under 20 billion at the moment of our 140, 150 billion. And my colleague Andrew Chambers said he can see the day when it's 50-50, and that's not because we're not going to keep growing with Australian clients. We're also doing a lot in private markets because our clients want that, and we're big already in public listed asset classes, but we're going to do a lot more in private. And there we've said we can see the day where we're 50-50 private markets and public markets. And that's not because we're not going to grow a lot in public markets. We've still got a huge amount of growth there. So We're growing a lot, and there's no reason in the world. I say the sad thing for me is that I'm not 15 or 20 years younger, because there's so much ahead for Pinnacle, and it'll be up to some others to take it forward, but the basis is there. We built what we call a platform that lends itself to growing tremendously. We're about to more or less duplicate in the UK and Europe our very successful Australian retail and wholesale distribution group based on this former Royal London team and so on. Anyway, I'm making my usual mistake of going off which, as Steve Wilson will tell you, I'm always in trouble for taking too much. You start me talking about Pinnacle, I'll never stop. Couple of quick slides here. That's just for people to try to get a little bit of an idea of who our current affiliates are. But another reason that I'm pleased to be here this morning is to continue a tradition and important relationships. These Morgan breakfasts are really a Brisbane institution now, having been consistently held for over 30 years. The attendees are a who's who of the Queensland business and investment community. I've known key Morgan's people also for decades now, over 40 years. I actually remember when Morgan's first began as a complete start-up boutique stockbroking firm. I was a young fellow then, so were you, Tim. And I remember the inception of Morgan's was a really significant development in Brisbane. I recall lots of meetings and interactions with Porky Morgan and Tim Cromlin. First when I was a young Queensland Treasury Division head, then in the early days of QIC we had a lot of dealings. So Morgan's with Tim at the helm over many years, and now people like Brian and John Clifford. Good, strong succession in place. It's grown enormously. It's an extremely high quality, successful and highly respected, a major Queensland-born success story, which I think Pinnacle also is. And if Morgans don't mind me saying so, I see strong parallels between the inception and growth and success of Morgans and that of Pinnacle, although Morgans have remained privately owned, and we at Pinnacle ultimately chose to list on the ASX to give us access to more capital. We do a lot of very good business together, Pinnacle and Morgans, to the great benefit of our mutual clients and our shareholders. Morgans promote many excellent quality Pinnacle affiliate investment products. So this slide gives you an idea of a few. I hope you recognise some of them. We offer a large range of now ETFs, listed investment companies, listed investment trusts, and unit trusts or managed funds. People may know of Hyperion, Australian and global equities, including the ETF HYGG, and Solaris Australian equities. Hyperion and Solaris are both Brisbane-based equities managers. Plato Australian Shares Income, Metrics and Coolabah, our interest yielding managers. Some of them you may know, MXT, MOT, more recently MRE from Metrics. And there's an ETF, HBRD from Coolabah, that's enormous. Antipodes and Firetrail Global Equities, Resolution Capital in global listed real estate and increasingly listed infrastructure, Palisade Infrastructure and 5V Private Equity in the private market space, to just name a few. I don't have time to go through all of them. Hopefully some of you are invested in the 5V Horizons Fund, where we're pioneering bringing private equity to the retail and wholesale market in Australia. Morgans have also promoted our stock, which has the ASX ticker PNI. Morgan's senior analyst, Scott Murdoch, happens to be at the same table, is clearly one of the best analysts of our stock. No, that's true. There are a number of them, and he is right up there as one of the very best. He has a long track record of strong insight into our company, almost since we effectively became listed, Scott. goes back a long way. And Scott, I know you recommended us as a buy or an add at least for the past couple of years as our share price rose from, I think it was around $9, I think $9.11 when you first said, get out and buy this thing. And about $9, and now we closed yesterday at $23.88. So people who followed Scott's recommendation have done pretty well. And as recently as last month, Morgans were a co-manager on our $400 million equity capital raise, where we offered shares at $20.30. And as I said, now trading at $23.88 last night. So just as Morgans were a startup in Brisbane over 40 years ago and are now a major business operating way beyond Queensland, so Pinnacle commenced as a startup just over 18 years ago as Pinnacle, but Wilson's and Steve incubated Hyperion before that, so our antecedents go back more than 20 years. So Wilson Stockbroking, Steve Wilson backed me by providing Pinnacle with capital, operational capabilities, and seeded the new Pinnacle business with their interest in Hyperion, which they had incubated. So we Pinnacle executives then rolled our equity up into the listed Wilsons a bit over 8 years ago with an equity swap, renamed the company Pinnacle, and we've grown from there. We've grown enormously over those 8 years. And we now have, as you've heard, 18 affiliates. And our market cap is now over $5.3 billion, and we're knocking on the door of the ASX 100. So look, I've got a few more slides on Pinnacle's growth. The graph on the left just shows our funds under management growth from, virtually nothing to 140 billion or whatever the last public number was. And on the right, it shows the composition of our client base. You'll see international is growing from, it was nothing, it's growing rapidly, and it is the fastest growing part of our client base. So we're expecting big things from overseas clients. I'm not going to go through all these. You know which one's up there? That one. So that's just, look, to talk about our growth, this is just a slide that we use. I don't expect you to read it all, but we have 3 horizons of growth. So people ask us why we're so confident that we'll keep growing so strongly. We've always had this strategy of 3 horizons. We call them 3, and we bucket them this way to be able to explain the impact on our P&L and our financials. But Horizon 1 is the main game. That is simply organic growth. That is simply getting more fund flows into the existing strategies of our 18 affiliates. If we're 140, 150 billion, the capacity of those affiliates is way north of 500 billion. So if we did nothing more than just continue with our existing strategies, we are a very high growth company. But we are doing more. Horizon 2 is where we build new capabilities, which we've got a long history of doing. We've sort of perfected that. As I mentioned, Royal London, the new very big sort of $50 billion capacity manager based in London. That's our newest build. We've also been building a lot of extra strategies in existing affiliates. That takes time, but the return on what we spend, we just expense it off our P&L Horizon 2. The return on that is enormous, and we've got a long track record of big returns on that. But in addition, this is why we listed. We have access to capital. Horizon 3 is where we buy into other fund managers and capabilities. What we have, we're now building quite a very strong track record of success in Horizon 3. This is things like we bought equity in Metrics, maybe about 5 years ago. We bought into Coolabah, we bought into 5V, and then very recently with this capital raise, we bought into VSS, a private equity and private credit manager in the US. We bought into Pacific Asset, which is sort of a multi-affiliate manager in London. And we've said we're going to do more. We've raised some extra dry powder. We expect to do more Horizon 3. How that works is we say we pay a fair price to buy equity in an existing manager. And as I keep saying to the market, and Scott knows this, even though he'd like it to buy more cheaply, when you're buying very high quality, high growth managers, you're not going to get them cheaply, so we pay a fair price for them. But we're a value add manager, we are not a financial investor in these things, so we will only invest in a manager if we are very confident that we can help them to grow by a lot more than they would have grown on their own. So within a couple of years, it looks like a cheap acquisition because they've grown a lot. That's our history with everything we've done so far. Fully expect to do the same thing with VSS and Pacific Asset, our newest ones, and we expect to do more of these. So that's the sort of multiple sources of growth. So you're not hostage to any particular market, any particular asset class. Whatever gets thrown at us by markets out there, we should have a lot of opportunity to keep growing. And that's very much the idea. People ask me what could go wrong. People ask about, the challenges of investment markets, especially the consolidation of the Australian institutional market that has continued at a pace, and their in-housing of investing. A lot of the big super funds doing their own, especially Aussie equities and so on. And they use a lot of passive funds because being cheap is an important part of their proposition, as they're very big up here, ART, Aussie Super, Aware Super and all those kind of... these are major clients of ours. We work with them in a lot of ways, but we won't supply them with high quality equities where we've got limited capacity because they won't pay our fees. But, our answer to all of this, and I could spend hours talking about the challenges we have out there and so on, but we're very confident we can keep growing whatever gets thrown at us because of our business model. The business model is so compelling, so successful. It brings us excellent investment managers. And also the diversification, multiple markets, so you're not hostage to any one particular market, and multiple sources of growth, as I've just said. But also globally, the funds management industry keeps growing and will keep growing, despite everything, despite all the worries that we have, all the sort of negatives out there. Over time, wealth grows. And that has to be invested. Investing is as hard as ever. So you need talent. And our model works anywhere where talent is fundamental to success. And that's in a lot of asset classes. That's basically everywhere in the world. So we're not going to do everything. We don't have to do everything. But the things we do, we need to do well. So we've now got a great record of the most talented investment professionals joining us. Over 80% of our strategies continuously outperform their benchmarks over, rolling 5-year periods. And so we've got a very, very strong record of investment success. So, so much more I'd love to say about Pinnacle, but I'm not going to. You see, I am disciplined, despite what everyone says about me all the time. I've also been asked to make a few comments, and Brian, you might want to wrap me up in a minute, but on the current macroeconomic outlook and outlook for markets, I have to admit I face that task with real trepidation right now. The current environment is confusing. There seem to be disconnects everywhere. Disconnects between the equity markets, which have been very strong for the past couple of years, especially large cap, especially US, but equities generally have been surprisingly very strong. But a disconnect between that and retail investor sentiment towards equities, which hasn't come back strongly yet. We think we're seeing some green shoots of that, but it's unusual that markets can be up so far and retail investors not coming back into the market anywhere near as strongly as they have in the past. Also disconnects with the real economy, which as measured is fairly strong, but prosperity and confidence feel very weak. So that's also a disconnect. Now, I'm not going to try to pretend to be an economic expert. We've got lots of those who we can listen to, and Morgan's always have economic experts. And I remember Noxia over the years. I'm probably out of date now, but Morgan's always had good economic advice. But just a few little thoughts, and then I'll stop, Brian, I promise. So to me, the dominant force impacting markets is monetary policy around the world, and thus interest rates and the cost of capital. It's about 3 years ago that we got that big shock and central banks started tightening. Shouldn't have been a shock. We all knew it was coming at some point, but it still sort of shocked markets when it happened. Inflation, productivity, geopolitics, the rate of economic growth and so on are all related, but their impact is translated ultimately into monetary authority actions, and this is what everyone's hanging on, trying to figure out what the world central banks are going to do. Last time I spoke at a Morgan's Breakfast was almost 4 years ago. I was first up immediately after the reopening from COVID. I've been locked out of Queensland. I was originally scheduled to speak in March 2020, and the day before I was locked out. And that was 11 months before I finally got here, and it was such a relief to be able to come up and see my mum for a start. But when the pandemic struck, I ended up doing a Morgan's morning meeting in Sydney, and I recall saying that day that this pandemic market crash, everything dropped 30%, will prove to be a good buying opportunity. Said that with some trepidation as everyone was sort of had all this shock on their faces everywhere. We didn't really know what was going to happen. But then in February 21, the breakfast here, I was asked to focus on the economic outlook, and it wasn't difficult to foresee that we're heading for very strong economic growth in 2021 from a fairly low base, supported by ongoing strong fiscal and monetary stimulus. And I finally found my notes from there yesterday, and I looked it up, and it's just instructive to look back and compare and in fact marvel at the enormous differences between the economic and market situation then and now. So I find it much more difficult to try to foresee what lies ahead for both the economy and markets now. We have a situation where inflation has emerged as a threat for the first time in decades. And we now know with the benefit of hindsight that we overstimulated, both monetary and fiscal was massively overstimulated. We didn't know, it's nobody's fault. None of us had a clue what was coming. But it turns out we got vaccines, we got lots of good things, and you'd have to say we actually, economically, we did well getting through it all, but we overstimulated, and combined with this reduction in world trade, that has taken away that wonderful environment that we had for so long, which, I mean, essentially it was really basically massive Chinese economic growth as millions and millions of people taking out of rural poverty, put into productive employment. They had all this export growth, and that was very deflationary for the world. Those forces, this is oversimplifying it, but those forces gave central banks the powder they stimulated the slightest hint of any problem. And how good was that? We don't have that anymore. And so that dream scenario is gone, and productivity has been a challenge since COVID. I've got my own theories as to why that is, but there's no question that that's the case. And into this mix comes a new US president with stated policies which, if implemented, could have huge impacts in either direction. Higher tariffs and less world trade are inflationary and would further detract from central banks' ability to stimulate. On the other hand, this less regulation, pro-business growth kind of policies are being welcomed and would work in the opposite direction, in the positive. Some of his initiatives, such as pro-tech, focus on government efficiency improvement, reduce red tape, etc., likely to be productivity enhancing and helpful for reducing inflation. To my mind, a sleeper factor could be his policies to drastically increase domestic fossil fuel energy production, oil and gas. I think he said pump, baby, pump. And I make no comment on the environmental and sort of moral impacts of this, but from an economic perspective, it could potentially be hugely beneficial for inflation and so on. Who knows what Trump will actually do, and so who can predict short-term movements in inflation, interest rates, economic growth, and thus markets. I've always been an optimist, and generally being an optimist serves you well. I think a medium-term sleeper, I'm not going to go through my notes here, is technology. I think technology can be the basis of tremendous improvements in productivity. It is coming. It is enormous. There is a revolution on the way. It's simplistically called AI, and everyone says, why are everyone getting so excited about AI? It's not just AI, it is the application of new technologies to mass uses. Now, we got that with the internet. In many ways, it sort of crept up on us and it's all a bit ho-hum now. But if you think about the massive productivity improvements we've had by unbelievable range of commercial uses of the internet to do things so much more efficiently and better and so on. This is coming again with AI, with technology, with blockchain. One of my pet things is there'll be a massive improvement in the efficiency of fund administration. Will come from new blockchain technology, etc. Anyway, I'm not going to keep going on there, but I think these are conditions in which markets can conceivably continue to move higher. I'm not predicting that. Valuations are stretched, and it's always dangerous when that's the case, but I would still counsel people against the temptation to bet against markets. There are good things happening out there, as well as the big, scary risks. There's always been things to be terrified about ever since I can remember in geopolitics and so on, but we seem to muddle our way through one way or another. They don't tend to work out to be as bad as we might imagine. So look, I've done my thing and gone over time, Brian. I apologise for being very ill-disciplined, but we want time for questions.